Turning to the risks, economic policy uncertainty is elevated, with likely policy shifts from many newly elected governments in 2024. In the near term, risks could exacerbate divergences between countries. The euro area could slow down more than anticipated due to weak momentum in manufacturing and fiscal vulnerabilities in some countries. For China, the risks are also to the downside. The economy is at risk of a debt deflation trap, and the decline in Chinese government bond yields shows rising investor concern. Both for the euro area and China, this could lower activity and inflation. For the US, many of the uncertainties originate with potential policy shifts under the new US administration. While these are hard to quantify precisely at this stage, we would categorize them as follows. First, there are demand-stimulating risks, such as a further fiscal stimulus or a confidence boom fueled by expected deregulation efforts. These would increase output and inflation in the near term. There are also supply-constraining risks, such as higher tariffs or curbs on migration. These would weigh on output, but also add to price pressures. The combined effect on output in the near term is uncertain, but likely to the upside in our assessment. Any combination of these policies, on the other hand, is likely to add to price pressures in the US. Higher inflation would prevent the Federal Reserve from cutting interest rates as initially planned. These policies will also likely strengthen the dollar and tighten financial conditions elsewhere, especially for emerging market and developing economies. In the medium term, the risks are more uniformly to the downside. Curbs on migration and protectionist policies will weigh on potential output. The initial positive effect of a fiscal expansion will wane, and the associated increase in public debt could lead to fiscal vulnerabilities further down the road. The increase in US long-term yields, despite the Federal Reserve easing, reflects some market nervousness about future fiscal policies. Deregulation could boost output by removing red tape and spurring innovation, but it could also increase financial vulnerabilities. Another risk is that renewed inflation pressures so soon after the recent episode could de-anchor inflation expectations as people and businesses have become much more vigilant.